Hey, fantastic folks, welcome back to another episode of Controversialism with Ankur Bhuya. Today, we are going to revisit a YouTube video which I published on March 26th, which is still relevant today. There was some issue with the audio, but this time it will not be an issue. So I am recording this particular episode again, which is from March 26th. I hope you enjoy it. So welcome to yet another episode of Controversialism. Today we will unravel the economic powerhouse of China. My focus today will be to drive your attention towards 5 reasons as to why the Chinese economy is getting into a slump and underperforming. So welcome back, fantastic folks. Today let's talk about China. The COVID pandemic had a very hard impact on the Chinese economy. Supply chains were disrupted, and China chose the path of stringent lockdowns. Most major economic activities grounded to a halt. The measures that the Chinese government took, apart from stringent lockdowns, were extensive testing and contact tracing, mandatory quarantine for travelers, strict border controls, and the use of technology for monitoring and enforcing quarantine measures. To add to it, lockdowns in infected areas have particularly been very severe in nature, with restrictions on movement, closure of businesses, and growing frustration in the Chinese public, augmented by constant isolation. It is very hard to get data out of China since the country keeps its information mostly confidential. Only a few high-ranking officials in the Chinese government would know the official toll of lives lost due to the Wuhan virus. According to an article published by the New York Times, the official death toll stood at 83,150 people. Many do agree this number is highly manipulated and deflated. As the economy came to a halt and then started sliding, many stories came to light about the Chinese efforts to absolve itself and mislead investigations into the origins of the Wuhan virus. Many in the intelligence community agree that the virus was developed in a government-controlled lab which somehow managed to escape and wreak havoc across the world. We would not be exploring this particular subject as of now, but still, if you want me to cover this topic, then please let me know in the comments section. A trust deficit started to be observed in the Western world against China. Today, China is much more vocal about its One China policy, and the communist government has become an important member of the alliance between Russia, China, Iran, and North Korea, forming a new axis in the geopolitical landscape of the world. 5 years back, the tone of Chinese propaganda was more nuanced than in recent times. In terms of the economy, the world at large came to realize its dependence on Chinese supply lines, catalyzing a strategic re-evaluation by most countries. Southeast Asian countries, notably Vietnam and Bangladesh, plus India, emerged as promising alternatives. Amidst the seismic shifts, statistics and investment figures highlight the transformative phase reshaping the geopolitical race for economic superiority. Coming back to China, the prolonged measure of the government like the zero COVID policy took a toll on China's economy as stated above. The Manufacturing Purchasing Managers Index (PMI) plunged below the growth threshold in 2021, signifying contraction. There was a decline in imports from China during the pandemic, and the year after indicated a strategic diversification trend. The US Census Bureau reported a 4.7% reduction in imports from China, validating this trend of countries finding alternative sourcing strategies. Southeast Asian nations witnessed a foreign direct investment, positioning them as lucrative manufacturing destinations. Let us take the case of Vietnam. In 2022, existing foreign investors like Samsung, Intel, Apple, and many other companies pumped in 1,570 new projects worth $9.9 billion, which is a 15% year-on-year increase. Total estimation pegs the amount of FDI stood at $16 billion. The import and export turnover grew 5.7% to $58.3 billion. The International Monetary Fund and the Asian Development Bank predicted Vietnam's growth to hit 6.5% to 7% shortly. If we look at India's FDI figures, then according to the Press Information Bureau of India, $21.3 billion has been infused into the Indian economy. Equity flow in the manufacturing sector increased by 76% in FY21 compared to previous financial years. The inflow of such huge investments has become an endorsement of India as a preferred investment destination for foreign investors. We all know how the Indian stock market surpassed the $4 trillion mark in recent times. Recovery post-pandemic has enabled India to hit its pre-COVID era peak of $55 billion in FDI in just 2 years post-pandemic. That too during multiple wars being fought across the world, notably Ukraine and Israel. Thus, this remarkable growth, despite global challenges, has given tailwinds to the Indian economy. A strong indicator is Apple starting to manufacture or assemble its products in India. This data was taken from the Economic Times report dated 11th January 2024. In the same period post-COVID, foreign direct investment in China started to shrink for the first time in a decade in 2023. This data was officially released by the Commerce Ministry of China. A report published by Reuters underscores the challenge Beijing faces if it is to win back foreign investors, as Western governments talk about de-risking, basically meaning not having all your eggs in one basket policy, which makes sense because in today's rapidly evolving world, no supply chain is immune from global conflicts. Example, the West Asian and Russian conflicts, which affected both oil and energy imports and the availability of wheat, two major factors of survival. During this time, India had to switch the supply of energy to Russia away from its traditional oil imports from the West Asian countries. Russia has consolidated its position as a steady source of India's energy requirement. The second major economic challenge China is facing is from the real estate sector. You must have heard about the Evergrande Group, which is one of the biggest real estate companies in China. According to a report from Hindustan Times, Evergrande is the world's most indebted real estate firm. Basically, they are drowning in loans. This crisis has been the center of an unprecedented liquidity crisis in China's property sector, which accounts for roughly 25% of the Chinese economy. Chinese real estate market was previously experiencing a boom. Many companies started taking massive loans at risky interest rates to fund their construction projects across China. With so much money being pumped into the construction sector, employment levels started to rise as there was a need to expand the workforce, and the auxiliary functions which supported this rapid expansion like cement, steel and many other supporting industries flourished. Everyone seemed to be making a profit that time. This dream soon became a nightmare. Many of the flats were not sold and the lavish buildings started to convert into ghost towns. There seemed to be a massive gap between supply and demand. Pricing strategy was lopsided and did not make sense considering the purchasing power of an average Chinese citizen. The world's economy was already struggling and China was not immune to this. Focusing on Evergrande and using it as a lens to gauge the state of the real estate companies in China is very important, since Evergrande was too big to fail. Investors still hoped that the government would step in and give a bailout, but nothing happened. By August 2021, the dominoes began to fall in place. Many Evergrande projects were halted due to overdue payments and cash crunch. By July 2023, Evergrande posted a net loss of 476 billion yuan for FY22 and 105 billion yuan for FY23. The group restructuring process did not yield results. In August 2023, Evergrande shares resumed trading after 17 months, but 79% of its market value was lost from when it was last traded. By November 2023, the group made last-minute debt restructuring proposal to offshore creditors seeking to prevent an imminent liquidation, which is selling its assets for pennies against the dollar. By January 2024, many top executives of the group found themselves embroiled in criminal investigations, diversion of company funds, and violating the trust of investors being some of the major allegations. Finally, a Hong Kong court issued a liquidation order to Evergrande. Debt estimates at that point for the company stood at $300 billion. Another major real estate group in China, the Country Garden, is also facing bankruptcy along with 230 home developers as of January 2024, as reported by the Economic Times. To add insult to injury, China's government keeps inadvertently hurting its economy. Data for 2023 is not good at all for China. Many analysts had predicted a bounce back after strict COVID-19 prevention measures were lifted in December 2022, but the economy underperformed in just about every economic indicator. The GDP growth was at 5.2%, a bit higher than expected. However, even that data is widely distrusted given the country's staggering youth unemployment, real estate crisis, disappointing stock market, and general local malice last year. The Chinese government is trying to attract foreign investors and stimulate domestic consumption, but acting as a counterweight to China's economic rise is a parallel set of measures by the Chinese Communist Party meant to improve or protect Chinese society, which has in recent years led to some undesired knockoff effects. China is on the path to overdrive its anti-corruption policies, which oftentimes Xi Jinping uses to settle personal scores against detractors. Over the past decade, 4.7 million officials have been punished under this policy. The top Chinese bureaucracy members are motivated to hunt down so-called tigers and flies. This cleanup has deepened across key industries such as finance, pharmaceuticals, and infrastructure. Government officials are now discouraged and paranoid from embarking on new projects for fear of being deemed corrupt and hurting investor confidence. Bank of America and Merrill Lynch in a 2014 report stated that China's anti-graft policy has cost its economy around $100 billion. And just last year, a crackdown on corruption in China's healthcare sector wiped out $142 billion from the market value of healthcare stocks. You must remember how Jack Ma, the founder of Alibaba e-commerce platform, suddenly disappeared after passively criticizing the government, and now he seemingly comes across as more tamed and restrained. Investors realize that no company or its founders are immune to Chinese policies. The CEO of JP Morgan and Chase, Jamie Dimon, went on to say, and I quote, "Anyone who is looking to invest in China has to be a little worried." Amidst increased political friction with the United States of America, China in July 2023 implemented a new anti-espionage law that sought to limit foreign consultancies over fears of giving them state secrets. Coupled with demoralizing economic policies, protectionism, and violent retaliation against dissidents of the Chinese Communist Party, China is projecting a very toxic work environment for foreign investors and domestic industries. China's expansionist plans, according to the One China philosophy, have soured the image of China on the global stage. Aggression shown towards Taiwan, muscle flexing on disputed borders with India and many other countries in the South China Sea like Indonesia and Vietnam can be termed as bullying. Currently, there are 8 territorial disputes in South China Sea which involves China. In some ways, this cumulatively shapes the third reason why the Chinese economy is failing. Foreign companies are shifting investments and their Asian headquarters outside China. According to a report by the European Chambers of Commerce, companies are uneasy about security controls, government protection of their Chinese rivals, and a lack of action on reform promises are some strong reasons for the exodus of investors and companies. The European Chamber of Commerce President Jens Eskelund went on to say that, and I quote, "Business confidence in China is pretty much at its lowest point we have on record." The signs are obvious. 1 in 10 companies ECC survey said that they have shifted investments out from China. 1 in 5 are delaying or considering shifting investments. In aviation and aerospace, 1 in 5 companies have no plans to invest in China. 2/3, that is 66% of the 570 companies surveyed, said doing business in China has become more difficult, up from less than 50% during the pre-COVID era. Companies are on edge after police raided offices of Bain and Company and Capvision, which are 2 consulting companies and a due diligence firm. The Mintz Group, without public explanations, has raised concerns. It seems that authorities say that companies are obliged to obey the law but have been given no indications of possible violations from China. 3 out of 5 investors are saying that the business environment in China has become more political. No wonder the Hong Kong stock market reported a sharp decline in recent times, with many investors pulling out their money. We have not even talked about the young population crisis China is facing, which is basically a reduction of workforce labor due to the one-child policy, or how initiatives like the Belt and Road projects are now seen as an instrument used by Xi Jinping government to drown countries in debt through infrastructure projects that do not benefit their partners. Rather, they are excuses for China to gain access to resources and political clout in its so-called partners in the BRI, the Border and Roads Initiative. The situation is so bad that Pakistan recently promised the International Monetary Fund that it would not pour foreign aid into BRI projects. Italy is ready to pull out, even at the cost of straining relationships with the second largest economy in the world. And I think this has already happened, based on news. The economic crisis in countries like Pakistan, Sri Lanka and Maldives, along with many African nations, is for the world to see. China is itself facing the effects of funding such large-scale projects. Most of the loans China gave to its partners are turning sour. In a report by the Times of India, a total of $76.8 billion in loans given by the Chinese investors have gone bad. This is another bubble waiting to burst. This is the 4th and 5th problems which are pulling down China's economy. In the interest of time, I am cutting off this session right here, because if I go on the narrative, will feel like opening a can of worms with multiple layers in between, which needs to be exposed. The real rot in the can. Many skeletons will emerge from the dark void of China's economic closet. As far as India is concerned, we have to put up a concerted effort to build our own manufacturing and services infrastructure. The government has to capitalize on this situation and slowly build competency to edge out, or at least nudge, the Chinese economic engine off its track. India has the advantage of being a democratic country with relatively stable government. Machinery initiatives like the Make in India point towards the right direction, but as a country, we need to invest some time in research, scientific advancement, infrastructure connectivity, upskilling and reskilling, plus various other building blocks of a strong economy. Thank you. Please don't forget to like this content and share it to increase the session's visibility, which will in turn help me to build my channel and come up with more interesting topics of study, along with the need for motivation to keep my work alive. So thank you, fantastic folks. I will be seeing you in the next episode.